I have with me a special guest today. We usually speak with him from Singapore or Hong Kong. But today, Manishi Roy Chaudhary, well, he's an emerging market expert and have been at various places, reputed places globally, now on his own. For the moment, let's see, till he shares the further plans. But let's scratch his brains about how he's analyzing stuff. Anishi, so nice to see you.
Absolutely, pleasure to be here.
Dropping by in our studios. There was a kind of a weakish patch we saw barely for a week or 10 days when we corrected from 23,000 to 21,800 odd. And at that time, the narrative got built in that China and Hong Kong markets have started to look very attractive versus India. So some money went there. But right now, of course, we are back at life highs. Can India afford to do well despite of some flows going to China?
I would think so. The basic growth story of India is still very much alive.
Intact.
And I don't think the foreign institutional investors have lost sight of that growth opportunity, which is not just over a few years, but it's possibly a decadal or a bi-decadal opportunity that we're looking at.
Sure.
What we had seen over the past 6 months or so when the FIIs were selling India and buying China is basically, the investors dipping into a very low valued market, which had corrected massively over the past 3 years. And therefore, some of the valuations in terms of price earnings, price to book, dividend yields were looking ridiculously cheap. Right. In contrast, at the beginning of this year, India was looking expensive not only in terms of its own history, but also relative to the other Asian markets. And as a consequence of what we've seen over the past 5 months, where India has suffered a time correction, that valuation gap has narrowed. One doesn't know whether it has narrowed adequately or to the full extent, but that narrowing of valuation premium has certainly occurred.
Manishi, we are also at the time that this latest bout of rally actually triggered by the hope of the market that Mr. Modi is coming back with the majority. Earlier, there was a sense that market got scared that may not come back with the same majority, weakish win. But in your conversations with institutional clients across the world, whenever politics used to come up, how big an issue is this for leadership of a country and the way Mr. Modi has led the country last 10 years?
I mean, you see, if investors hate uncertainty. That's the ultimate bottom line, and one has to underscore that statement several times. If we do have political and policy continuity in whatever form, I think investors would really like that. And at the same time, the conversation right now is not so much in terms of a change in government, but by what or the kind of margin, kind of majority that the existing government would come back to. Now, suppose we do have an outcome which is somewhat similar to the last elections, or maybe the BJP getting slightly fewer seats, but still maintaining a majority on its own. One could see a bit of a knee-jerk correction, but I think ultimately it's policy continuity, economic policy continuity, that would steal a march on what we call sort of electoral entertainment.
Wow, what a point. Very interesting point.
Ultimately, what we are seeing now, this discussion about whether it'll be 300 to BJP or 320 or 350, that's it's kind of in the realms of electoral entertainment. What really matters is the economic policy. What we have seen over the past few years, focus on infrastructure, supply-side measures, fiscal discipline, whether that strain of policy measures would continue or not.
And if you see a semblance, or the investors see a semblance of that continuity, that they don't steer more towards populism, all these prudent norms which have been kind of observed with for the last 10 years, it continues, then the economic momentum continues, and so does corporate earnings and hence markets.
Absolutely. I mean, that's the simple conclusion.
But out of all the work done on power, digitization, etc., all of that, what would you watch out for, or fiscal prudence for that matter? Growth, we managed to have very good growth. Look at the dividend which RBI recently gave out to them. What are some of the things which stood out for you and you would like the new government to also continue and press upon in the next new term as well?
I would definitely look for two things. Number one, this continued investment in infrastructure that we're seeing. If you look at the government's capex, the government's infrastructure investments, as a proportion of the total budget, that is actually almost, I think, it's actually more than doubled over the past 3 or 4 years, right? It's now at about 25% or so. Second, I would also, and it might seem to be contradictory at some point of time, but I would also like to see fiscal discipline. You know, since the kind of fiscal expansion right after COVID around that time, fiscal deficit has been coming down and the targeted numbers are even more encouraging. It's been helped by very robust tax collection, so that's another point to look forward to. And something new or some acceleration of something that's already been going on is the focus and encouragement towards acceleration in manufacturing, particularly advanced electronics and likes. We still have a long way to go.
Sure.
And not just the fiscal incentives in the form of PLIs, there has to be a focus on skill creation.
Yeah.
You know, we're just scratching the surface as far as that is concerned, but those are the things I would certainly look at.
What are your thoughts on the quality of earnings which have been coming out this quarter in particular?
Right.
You know, some areas are springing very good surprises like consumption. All the large consumer companies said green shoots, etc.
Right.
At the same time, there is a view turning that going forward, which is the first quarter onwards, one needs to watch whether the margin expansion story, which has lasted 4-5 quarters, will continue or not, because commodities have rallied.
Right.
And to couple it up, if top line also remains anemic, what happens to the market? What are your thoughts on earnings?
No, that's a fair point, and particularly because you mentioned consumers. If you look at the large consumer staples companies which are very well penetrated into both urban and rural India, for them the growth opportunities are relatively limited, and that's why, you know, I think, you know, these frontline large consumer staples companies, and I make a distinction between staples and discretionaries here. The staples companies have been complaining about relatively pedestrian growth, pressure on margins, you know, so that's an area I would be cautious about. Discretionaries, particularly those discretionaries which are catering to what we call affluent India, I think they are relatively safe, not just now, but even over the next 5 to 10 years. As we gradually see the, you know, the income brackets, you know, keep increasing, continue to move higher, obviously, not only would the consumption package of Indians change, but how they consume, that would also change, which we are already beginning to see.
One more thing I wanted to discuss before we wrap, Manishi, is that the data shows that on the face of it, when we look at FII number, it looks like a big sell number for months now.
Right.
But within that, if you scratch further, one is getting a sense that FIIs are shuffling positions and they are broadening their holding as well.
Right.
Aggregate holding may be at 11-year low, but the penetration toward mid cap and small caps has gone up. Their movement is away from certain sectors.
Right.
What do you make of that?
Earlier, I mean, if I go back, let's say about 3 to 4 years, the bulk of FII investment used to be in 2 sectors, private sector banks and IT services. And those are the two that they have relatively sold out of. They have trimmed, they have moved more into mid caps, not to the extent that possibly some fund managers would like them to move into small caps yet. And a few other sectors which they were not present in historically. Capital goods, industrials, the power sector. So I think this is an encouraging sign. There are enough opportunities in India in the sectors which hitherto had not performed, and I think that's an indication that we're going to see.
How much probability would you assign? You know the nature of some of your international clients so well, which are well entrenched in India.
Right.
How much probability would you assign that the next few months FIs will also come back to India?
I think what I would really look at are, number one, a broader movement of funds towards emerging markets. And for that, we need to have this narrative of higher rates for longer in the Western Hemisphere, in the US, change considerably. Unfortunately, I don't think that's going to happen anytime soon. You know, because if you look at the Fed statement, if you look at the most recent minutes of meetings, if you look at the CPI print in April, it seems clear that the Fed would be data dependent. They're not going to act in a hurry. You know, and you know, of course, the silver lining is that earnings growth is strong in the United States, and that's what the market is focusing on right now. But it also means that for now, the funds would remain focused on the United States, on the developed markets, and US tech, on the likes of NVIDIA and Meta and so on and so forth. For that focus to come back sustainably in emerging markets, the rate narrative and the US dollar narrative has to change. Okay. Till then, we would possibly see this, 3 steps forward and 2 steps back as far as the FII flows into India and other Asian markets are concerned.
Right. All right, Manishi, thanks very much for dropping by and sharing your thoughts. See you around more often right now that you're on your holiday and, of course, in the middle of changing careers or perhaps your road from here. Thanks very much.
Thank you very much.
If you like this video, then like, share and subscribe to ET Now.